fiscal focus to respond to slowdown limited.
Okay, good morning everyone. Welcome to the Reserve Bank and our biannual financial stability review. For those of you who don't know me, I'm Grant Spencer, Deputy Governor. Now the Governor and I normally do this jointly, but unfortunately the Governor has had a bereavement in the family, so he won't be able to join us this morning. But I do have with me Bernard Hodgetts, who's Head of Macro Financial Stability, the area that produces this document. So the key message of this review is that the risks facing New Zealand have increased, and this is largely due to the Euro sovereign debt crisis. Indeed, not just in Europe, but in many countries, financial systems remain under stress due to an overhang of private and public debt. The markets have been particularly concerned about the situation in Greece and the potential for contagion to other countries and to the banking system. And this has made access to the offshore debt markets more challenging for New Zealand's banks. In New Zealand, households and businesses have been containing debt, which has helped to reduce the country's overall external imbalance. However, this has been offset in part by rising levels of public debt. Further, many households and farmers remain highly leveraged, which leaves them vulnerable to any downturn in the global economy. Turning to the banking system, we believe the banks are better placed to weather the current financial storm than they were back in 2008 at the start of the financial crisis. The banks have significantly increased both their capital and liquidity buffers in recent years. They now have a much stronger retail funding base, and the term of their wholesale funding is now much longer. So this makes them less vulnerable to disruptions in offshore markets. But given the current market tensions, however, we have decided to defer by 6 months the planned further increase in the core funding ratio, which was to have occurred mid next year, from 70 to 75%. That will now be pushed out 6 months and will take place in January 2013. So this will give the banks a bit more latitude in managing their funding programs over the coming period. On the policy side, we have continued to progress a number of regulatory initiatives. A couple of days ago we put out a consultation document on Basel III, where we are expecting that the capital requirements will be increased to match the new international standards. We've also been in discussion with the banks on pre-positioning their systems for our open bank resolution policy. And finally, in the insurance sector, we have issued new solvency standards, and we're very busy processing applications under the new licensing framework. So we're happy to open up to questions. I would say that we won't be commenting on any party political issues, but certainly happy to answer questions on the financial stability review. So any questions?
How much have these global risks intensified since the last monetary policy statement and then the last OCR statement in October?
Well, the situation, I think, it's been up and down, and I think definitely the situation is worse now. We had a lot of build-up to the proposed European package that was meant to sort of solve the problems. Clearly, that package did not gain the confidence of the markets. There's been problems in Greece, political problems with the referendum being called, and now a change of government there. There's some suggestion that they will now knuckle down and put the new Greek program in place, but clearly that country is still under a lot of pressure. There's still a high probability that there will be effectively a default in Greece, and therefore the market's worrying about the contagion effects from that to other countries and to the banking system. And clearly, they're particularly worried right now about the implications for Italy, which has a very large amount of public debt, and you know, the concern is that if that is the next domino after Greece, then that could be a real problem, because of course it's a much larger country with a much larger amount of debt.
Obviously this text would have been finalised before what we've seen in, I mean, last night in Italy and the last couple of days with their interest rates going much higher.
Yes.
And so could say it's sort of day in, day out, and it's just getting worse by the day. Would you say things have, it's a bit hard to say, but would you say things would have even got worse since you finalised the text?
Well, it's not, I don't think it's worse by the day. It tends to come and go. You know, we still have days of risk on, risk off. Last night was a risk off night. The Kiwi fell, stock markets fell, but there's volatility, and I think that volatility will continue, and I think that's our main concern, that this is likely to continue for months and could easily go into next year, and that's why we have given the banks a little bit more latitude with their funding. So even though they have good funding buffers at present, and they're not having to rush out into the markets, we didn't want to put the pressure on of pushing the core funding ratio up further next year, because you know, these issues could well be flowing into next year. But you know, we don't want to overstate them. It's not the end of the world. New Zealand is still more dependent on Asia than Europe. Asia and China is still growing quite strongly. Commodity prices have come off, but they're still at high levels. So we're not trying to, these are risks, they're not actual outcomes. And you know, we're still seeing in the New Zealand economy a reasonably positive outlook.
You said that a drop in private debt being offset by the rise in public debt. Sorry, you said that the drop in private debt's been offset by a rise in public debt. Do you accept that sort of nominal figure that has been set of trying to keep public debt at no higher than 30%, net debt at no higher than 30% of GDP?
Yes, I think that is certainly a reasonable target, something that can be achieved and something that we support. So, you know, public debt has increased in New Zealand, but clearly the public debt at sort of 30% or 30% gross, 20% net, I think at present, is still relatively low by these international standards when you look at Europe, Greece, Italy, etc. But we want to make sure that we don't get up to those higher levels, and so the government's objective is to reduce those levels, and we certainly support that.
What levels, though, would start to worry you if it started pushing above that? Where would you start to get worried?
I think the main target, the main thing to achieve is the trend rather than any particular level. I think it's important to achieve and show signs of achieving the fiscal consolidation that everyone's expecting, the market's expecting. So the markets are being positive towards New Zealand, they're buying our bonds, and that confidence really requires evidence of the just consolidation, of going in the right direction.
There's some fairly cautious words in here about the currency. I think you've got warning about possibility of a sharp deterioration was the term used. Are you sort of talking down the currency at the moment?
Oh, we never do that. But no, we're not trying to influence the currency in one direction or another. I think clearly we have felt over quite a period that the currency has probably been higher than justified on a long-term basis. But right now, obviously, the currency is somewhat softer as a result of this risk-off environment in the markets, which has softened the currency. Now, there's a risk if things deteriorated further, obviously, that the currency could weaken, and that's mentioned in the document. But we don't see that as a high probability outcome.
You take comfort from the fact, and have for years, that a high proportion of New Zealand's overseas debt is denominated in New Zealand dollars. I wondered, though, if you see any risk to the ongoing ability of borrowers to sort of peel off the foreign exchange risk and find counterparties for the hedging. Is there any signs of stress there, or any reason to think that the cost of that may climb?
Well, Simon might, or Bernard might be able to comment on this, but I mean, the cost of hedging has increased, there's no doubt about that. So the banks will typically raise funds in US dollars or euros or yen and then swap it back to New Zealand dollars. And that swap, the cost of the swap has increased over the past 6 months or so. Whether that's likely to deteriorate further, do you have any thoughts on that, Simon? Here, take the...
Markets are still pretty efficient at the moment, and as Grant said, they're still pretty positive on New Zealand, so our banks are able to access funds and swap them in. Obviously the global markets are pretty ugly, but there's no signs that they can't get rid of their currency risk when they decide to borrow money offshore.
So there's still the appetite for New Zealand dollars, and that's seen, for example, in the government's DMO's debt auctions, because a lot of the interest in those auctions comes from offshore. And so there's still that underlying appetite for New Zealand dollars, which means that the banks will be able to hedge their foreign borrowing.
There also seems to be something of a catch-22 in your story. I mean, there's this theme of, debt equals risk, but you also say at one point that the lower debt appetite has weakened the recovery and could in turn make sustainable debt repayments more difficult. What do you want, more debt or less debt?
Well, certainly when we're talking about financial stability, we want less debt. But I think that comment's really saying that as we're seeing our businesses and households reducing debt, they're not spending as much, they're saving more, which means that tends to be a bit of a drag on domestic demand, and so the recovery is not going to be as strong. But, in terms of achieving long-term sustainable growth, you do need to get debt levels down to sustainable levels. So, it's our view that it's better to consolidate and to get our balance sheet in shape rather than continuing to spend and accumulate more debt.
The amount of funding that the banks have, there's quite a bit in the report about things are a lot more stable than they were in 2008. There still seems to be quite a big dependence on offshore and I guess other funds, less stable funds. At what point do things get to a more stable level, if you like?
Well, Bernard might have some views on this, but our core funding ratio is aimed to get to 75%, but that would mean that 75% of the bank's funding is either retail funding, or long-term wholesale. Now, the more New Zealand can get to a sort of a self-sustaining position and improve its own savings rather than relying on foreigners' savings, then that's going to be a much stronger economy and be a stronger basis for sustainable growth. But given New Zealand's history, there's always going to be, I think, some reliance on foreign borrowing. I don't think we're going to see the current account go in surplus anytime soon, or probably not maybe not in my lifetime, but so long as we have a current account deficit, there's going to be some of the bank's borrowing is going to be from offshore. In terms of percentage, have you got any thoughts on this, Bernard?
Yeah, I mean, I think I'd just make the point we've made an awful lot of progress over the last 2 or 3 years. I mean, as we mentioned before, the banks have lifted their reliance on domestic retail deposits quite considerably over that period. They've lengthened the maturity structure of the wholesale funding that they are doing offshore, so they are less reliant on those very short-term offshore markets than they were. And as we've also mentioned, I mean, the increase in the core funding ratio planned for 2013 is sort of designed to, if you like, lift the system to another notch again in terms of those improvements. So we've definitely been heading in the right direction. We still clearly have a reliance on international markets, and I mean, I think it's unrealistic to think that will ever drop away to nothing, but certainly the vulnerabilities there have reduced quite considerably in the last couple of years.
Can I just get a couple of basic things? What are the factors behind the high levels of public debt, I suppose, and to what extent is it a problem?
Well, the government has been running deficits. There's a chart in here showing that quite clearly how the deficits have appeared around 2008 and then worsened through to the current time. Now that's been related to the initial recession, the financial crisis. Weakening a recession tends to reduce revenues, increase spending, so you tend to get a worsening in the fiscal position during a downturn. But on top of that, of course, over the past year or so, we've had the impact of the earthquake, the Canterbury earthquakes, which have really put a significant further impost on the public finances. So as we go forward, you know, the earthquake effect will come out, as well as the efforts by government to reduce the underlying deficit.
And just the farm debt, I mean, to what extent is that now a problem?
Well, farm debt was certainly an issue that we've flagged here, and you know, the initial problem we thought arose when there was a huge expansion in farm credit back in sort of 2008, 2009 with the initial commodity boom. Then commodity prices came off and the farmers were looking pretty vulnerable for a while. But now, in terms of trade and farm prices increased, so it gave them more room for a bit more of a buffer. But the banks and the farmers, I think, realised they'd taken on too much debt during that boom that we had, particularly in dairy farm prices. And so over the past year or two, they've really been working to reduce those high levels of farm debt, particularly in the dairy sector. And that is now sort of starting to show dividends. Also, we see in here that the level of non-performing loans in the agricultural sector in the last 9 months is coming off. So I think we're past the worst in terms of the losses we're seeing in that.
And sorry, can you just outline for us, you know, the biggest risk to New Zealand, again, I suppose, of this European debt crisis? You were talking in terms of offshore borrowing and access to funds, basically.
Well, in terms of the big picture with the European crisis, there's really two main risks. One is the financial risk and one is the real economy risk. The financial risk is the one we've been talking about, where the financial markets are disrupted and makes it harder for our banks to borrow funds and to feed their the New Zealand economy, which is still reliant, as we said, to some extent on foreign borrowing. So that will reduce the availability of credit and or increase the cost of credit, potentially, if Europe, stays as it is or gets worse. The other side of it is the real economy one, where, this whole development in Europe is worsening the European economy on top of a weakness in the US economy. Is going to have significant effects on overall global demand and global activity, which particularly, there's a big uncertainty of how big an effect that is on China, whether China can continue to grow on its own, or whether it would suffer as a result of a deterioration in the Western economies. If it does suffer, then you could have a downturn in commodity prices, and we would get hit through that channel as well. So those are the two main channels from Europe. Bernard.
Grant, so could you explain in a bit more depth why you decided to defer the core funding ratio increase? Because, as I understand it, many of the banks are already at that higher level or close to it.
Yes, the banks have buffers. As we said, they've built up their liquidity buffers as core funding. But basically we want them to be able to use the buffers. This is a thing it was a bit of an issue with prudential policy. You require a bank to have a capital buffer or liquidity buffer, and then when the tough times come, if you say, well, you can't use the buffer, then it's not much good to them. So we want to make sure that they have the capacity and not forced to go out to the market to maintain the buffer or the margin above our minimum requirement. So I'd say there's sort of there's a micro sort of rationale and a macro rationale. The micro rationale is just, we don't want to put unnecessary pressure on the banks in light of what's happening in the global funding markets. We want them to be able to use the liquidity buffers that they've built up. The macro aspect is that if they were forced to go out and fund in these difficult markets, and the European problems were persisting, and so the cost of funding was very high, then that's going to have a potential macro effect back in New Zealand in terms of reduced availability of credit and or much higher cost of credit. So we don't want to put additional pressure on credit, cost of credit, and the macro economy. So there's those two sides to it.
Why not simply force the banks to raise more of their funding from local term deposit sources by increasing their interest rates?
Well, of course, what happens is when we do put the core funding ratio up, they can meet that requirement either by going to the term markets offshore or the retail funding markets, and that's what they've done. And that's what's contributed to the much more higher level of term deposit rates that we've seen in the past couple of years.
But that
relative to wholesale rates, they've gone up a lot, right? And so that's part of the mechanism. So they make the choice. We say you need so much core funding, then we let them make the choice about whether they go for retail deposits or term funding. Now the retail deposits are more solid. They're a more dependable source of funding in New Zealand, and so ideally you might say, well, why don't we just require them to get all retail deposit funding? The trouble is that the country is still running a deficit. So if we told them, well, there wouldn't be enough, there's not enough savings to meet those ratios for all the banks. If the country has to borrow, the banks have to do some offshore borrowing.
On that issue of the country having to borrow, you're quite a young man. You said you didn't expect to see a current account deficit in your surplus in your lifetime. Is that a worry for a country that borrows too much and needs to repay that debt at some stage?
It's not necessarily a worry as long as the debt ratios don't blow out. So, in fact, I mean, we've had an improvement in our net international position in the past few years. It's gone from, 85% to 70%, something like that, of GDP. So this is our New Zealand's net external debt relative to GDP has actually fallen. And so even though we're still running deficits. So it's a matter of having, you can run deficits, but they can't get too big. If they're too big, then you've got a problem. So it's a matter of the size of the deficit relative to the growth of the economy and the level of interest rates.
Just on that retail funding side, I mean, you'll see in the document there's a chart there of the retail funding growth that the banks have been achieving over the last year or so, and I mean there has been significant growth in deposits through that period. I think they're up about 8% on the year. So, you know, clearly they are tapping the retail deposit markets pretty aggressively in terms of the amount of extra funding they're raising.
But their term deposit rates have been falling in recent months.
Possibly because they've been able to raise money fairly easily from the market. You know, the margins have come back slightly.
Without being specific on political parties, I'm just wondering whether you're relaxed about what's being said during the campaign in terms of debt.
Well, we certainly support the policy of both the government and the opposition of consolidating the public debt and moving back to surplus. So, you know, as we say in the document, we're very supportive of that broad policy.
Is it achievable?
We think it is achievable, yes.
Grant, can I ask you just about the deferment? Did the banks ask for a deferment?
No. There haven't been any particular official requests. I mean, there's been discussion of it, of the ratio and the fact that it was not, you know, when we said we were moving it up in 3 stages, we said that, you know, each stage would be reviewed in light of market conditions, and so they understood that, and on this occasion we have assessed the market conditions and made the deferral.
So that deferral could be extended again if markets haven't improved by January?
That's possible, yes. It's possible, but our intention at this point is that it would take place on January 2013. So it's definitely still our intention to move it to 75, but it's possible the timing could change. But, you know, given current conditions, we think that we're giving quite a lot of latitude moving it out 6 months, and we think that should be able to happen in early 2013.
Are you concerned that the banks are increasing their exposure to the European debt markets by borrowing covered bonds?
Well, no, they're not. Their exposure to European banks and Europe in general is very negligible in terms of their asset, their credit exposure. They have some counterparty exposure, which is broadly covered, generally covered by collateral agreements. But on the funding side, then you know, that's not an exposure. When you're borrowing from someone, you're not exposing to failure. You don't have an exposure to the failure of that person because they're borrowing from you. You're not borrowing from them. So the covered bonds, we think, are a sensible further weapon, if you like, in the arsenal to help fund the bank. So they've got retail deposits, they've got senior unsecured debt, short-term, long-term, and then they've got these covered bonds which they can now use to borrow money. And in these volatile times, it's easier to sell a covered bond than it is to sell senior debt, unsecured debt, because covered bonds essentially have security attached to them. And so we've said that they can issue covered bonds up to 10% of their total book, and we think that's a reasonable policy, and a number of the banks have gone out and used that ability, and so it's a more stable market, and also it's at a lower cost because those funds are safer for the investor.
But aren't the banks increasing their exposure to the European financial system by borrowing even at long terms? And if, for example, there was some sort of crisis in Europe, which means the banks wanted that money back when those bonds matured, that we're exposed to that European market?
Well, if you borrow money, if I borrow money from you and you go bankrupt, then I either don't pay the money back or I pay it back to your receiver or whoever's managing your affairs when you go bankrupt. So I'm still having to pay the money back, but our banks will still pay those funds back. It doesn't really matter whether you're a European or an American.
But there's a rollover risk.
Simon, do you want to have a go at this one?
Well, yes, refinancing risk, but the whole purpose of the core funding ratio is to lengthen and diversify the funding of the banks to reduce this refinancing risk. 5 years ago, when they had a substantial amount of short-term funding, they had a far higher refinancing risk. So diversifying and lengthening the funding reduces these risks, and as Bernard and Grant has said, it's far less than it was, going into the the GFC. Now they've got far diverse and longer borrowing, so the refinancing risk is far less. But yeah, sure, if you borrow in markets, you've got to refinance it, so that's always a risk.
The decision is it working? Okay. The decision to defer the core funding, the next iteration, out to January, did, given the Reserve Bank room to move on the OCR, play any part in that decision?
No, this is not a monetary policy decision. Decision was made in the context of financial stability and our prudential policy. As I say, it has a micro aspect. It also does have a macro aspect, and in that sense, once we've made that decision, then that will have implications for the December monetary policy review, which we'll be doing in a few weeks. So in that review, then this change will have to be taken into account when the monetary policy decision is being made.
Could you describe this then as a loosening of monetary conditions by allowing the banks more flexibility on their funding?
I wouldn't say that, no. I'd say that if we went ahead with it, then it would potentially increase the cost of funds for the banks, which would potentially have put upward pressure on interest rates.
But not the other way around?
Well, it's a counterfactual, depends what way you want to look at it.
I think delaying the increase is, I think that if you delay the increase, it's a loosening.
It's a loosening in the impact relative to what it would have been. The thing is, of course, that the marginal cost of funds out there now on term funding is considerably higher than the current cost of funds of the banks. So, the current cost of funds is something like 150 points over the wholesale rates, over the swap rates. And if they were going to go into those markets now, you'd be paying well over 200. So what we're saying is that if the market, if these conditions continue, and the banks actually have to start funding in those markets, then their cost of funds are going to go up.
Grant, if this business, over here, if this business in Europe continues for a while and there is no resolution, when should we expect to start seeing it impacting New Zealand?
Well, that's a good question. It's a bit of a tricky question because it relates to what we were just talking about as to how soon the banks would have to start accessing markets at a higher cost of funds. At present, they're sitting back and saying, let's wait and see if things cool down. But I think, if you get to the end of the year into early next year, then clearly some funding will have to take place. There'll be some implications. So the longer this goes on, the more likely it is there's going to be implications in terms of impacts on reduced credit and or higher cost of credit.
I mean, the one factor that's, I guess, alleviating some of that pressure at the moment is the fact that the banks are doing very little new lending, and so the balance sheets are fairly static, and that of course is reducing pressure to raise new funding. So that's probably a factor that's helping to if you like, defer the effects of any tightening in global debt markets.
In terms of the real economy channel you mentioned before, Christine Lagarde is quoted as saying talking about the possibility of a lost decade for the global economy. Would you go that far, or
I wouldn't go that far, no. No, I mean, we don't know how long this is going to take to resolve, but clearly it's going to have significant implications for Europe. But the United States is really more the master of its own destiny. It's not going to be driven by what happens in Europe, and I think Asia is increasingly independently driven as well. So even if the European situation takes a year or so to resolve, I don't see it having that dramatic effect as to causing a sort of global weakness for an extended period.
Right, just in terms of that rollover, banks having to go back into the markets again, you said end of the year or early next year. So how much in a ballpark are we actually talking about them having to get?
Well, I don't really have those numbers to hand, and the numbers, as Bernard said, if credit remains weak, credit demands remains weak, then the volumes that the banks will have to go out for will still be relatively low.
So what this is rollover money, is it?
Yeah, yeah.
The US Treasury Secretary has warned of catastrophic bank runs in Europe unless Europe gets its act together. Has the Reserve Bank done contingency planning for that?
We certainly watch the situation very closely. As you know, we manage the foreign reserves, so we have exposures to foreign institutions, and so we watch those markets very closely, and we manage our exposures accordingly. So if that's what you're driving at, yes, we do manage it carefully.
And are you concerned at all about bank lending standards in the property market now that we've got 95% home lending and 5 times income lending going on, and that particularly in central Auckland house prices are up 15-16% from a year ago again?
We're not concerned at this point. There has been some relaxation of credit standards, but the sort of volumes we're talking about are still very low. Total new credit is low, and then the amount that's in those high LVR buckets is even lower. And most of the banks have limits on the amount of lending that they put in those high LVR categories. So we're not concerned, no.
I just had another question about covered bonds, because if it is more stable and lower cost, is there the possibility of increasing that 10% and allowing banks to push that out a bit?
We would not expect to increase that ratio, no. There's an issue because of the nature of covered bonds where the investor has a claim on the pool of assets but also on the whole bank. Then the higher that ratio gets, then you potentially dilute the safety, if you like, of the unsecured creditors and depositors. And that's why we set the limit, and we don't think it would make sense to change it.
So just continuing with comments on the New Zealand dollar in the FSR, it seems, are you picking a peak? That was a peak? And if it was, have you helped it off the peak?
We don't forecast the exchange rate, and we don't try to say whether we've had a peak or not, so we'll leave that for you to determine or forecast. But with the current situation of this risky risk-off, if you like, and the negative feelings around the global markets, then we wouldn't really expect to see a lot of strength in the currency in the near term. Okay, thanks very much, everyone. We've had a good round of questions, so thanks for coming along, and enjoy the rest of your day. Thanks.
Thank you.